Good morning. My name is Robert Fatter. I work for a company called Cresco Project Finance. We're a project finance advisory business. We help promoters take their projects through to this mythical place called financial close, where the cash is available so the engineers can build the cool toy that they've designed, be it mining, energy, and things like that. Most of the directors at Cresco have come out of the financing world, being previously at banks. So we act on behalf of the promoter and understand what a bank or another equity investor will require for them to give you money. We focus on a niche type of the project which is called project finance, and that is where the asset stands alone as security for the banks, as opposed to the traditional corporate financing where daddy has a balance sheet and the banks are less concerned with what the actual money is being spent on, as long as they have security from other cash flows. Historically, half our business has been outside of South Africa and half is inside South Africa. At the moment, we're very involved in the renewable energy space, which obviously is very interesting for many of the consulting engineers and engineering contractors out there. So we're on that. However, we are also looking at getting out. I think there's been a lot of learnings from this process, and we're seeing that this similar program could be rolled out into Africa. So I think for a lot of the people who've cut their teeth in the South African environment, the learnings, both commercially, financially, as well as technically, could be rolled out across borders and things like that. There's two parts to Cresco. One is the financial advisory, where we want to be involved up front, albeit that our involvement is quite limited. We just want to, and in many ways, we get paid to do a little bit of our own due diligence. To look at this project, is it worth backing? Often clients come to us and they say, we want you to be the financial advisor, but we want you to take a large amount of success, as in linking our fees to financing. And obviously, we're only willing to do that if we have a horse that we think is going to cross the line. So in those early stages, we're probably not willing to do it, but in the middle of bankable feasibility, based on certain milestones being achieved, we are willing to do that. One of the other sides of our business is on our project management side. And there we've seen that in a lot of these projects, and less so maybe bank and concept and pre-feasibility stage, but definitely during bankable feasibility stage, someone needs to pull together all the parts of the project. The technical guys are focusing on what they're good at, which is the technical bits. But everything else needs to come on stream at the same time. A simple idea is if we need a tax clearance certificate to achieve financial close, and that's going to take us 6 months, and your EPC contract's expiring in 3 months, then we should delay the contracting of the EPC because everything needs to come together at the same time. And therefore, we manage that process, looking at the commercial issues, tying into the technical guys to make sure that their deliverables are arriving at the right time, as well as their deliverables arriving at the right time with reference to the scheme. Because often we should actually delay their deliverables because certain other commercial documents are not within our control. Historically, financing, there was quite a bit of it around. In the early 90s, there was more money than there were projects. And generally bankable feasibilities were primarily a technical document. The engineers used to prepare something, there was a 95% cost estimate, deliver it, the banks used to go yes, and they used to sort of close their eyes and sign it away. Now obviously the world has changed, both early 2000s as well as mid 2000s, 08 when the crashes happened. And now bankable feasibilities are becoming a lot more of a holistic solution, which needs to consider the commercial aspects, the financing aspects, the legal aspects, environmental, and the technical aspects. And in most projects, the technical aspects might be the bulk of the work, but in many cases it should be the easiest because it should be proven technologies and things like that. The commercial issues are often the ones that are harder to quantify and harder to get through. Be it a concession from a government, be it a PPA from a government, be it some sort of infrastructure linkage and things like that that makes your project possible. And that's what we focus on, is pulling those linkages together and then working with the consulting engineer or the contractor to get their bankable feasibility to cover all the options or all the risks or mitigate all the risks so that the money is available. Banks will only give you money on a project finance basis if every risk has been mitigated to the right level. And in many cases, that risk needs to be taken by the counterparty who can take that risk. If it's completion risk, it's the EPC contractor. If it's supply risk, it's the person providing the supply, be it an Eskom or be it a raw material. On the offtake side, it needs to either be the utility who's buying your power, or an international trader who's buying your commodity, or even a bank who's providing you with a long-term hedge. Whereas in many cases, the project itself cannot take that risk, and therefore those risks are passed out at a cost to the people who can take it. And that's really our niche that we sit with there. We work with most of the consulting engineers and contractors in a support role. More and more we see feasibilities requesting a lot more financial inputs, either starting it as a financial model or as a risk matrix, and then obviously how you look at financing these opportunities. We've done quite a bit of work with junior miners who come in. They have some very high expectations around the type of gearing levels that people expect in junior mining projects. And in many cases, we need to pull them back to reality to say, this is the first of its kind graphite project in Madagascar. We're probably not going to get 80% gearing for something like this. If it was a coal washing plant sitting next to Medupi Power Station, bad example of a power station, Hendrina Power Station that works, then you might get similar gearing levels. So you need to have your horses for courses. There's no one size fits all. So our end goal for most people is financial close. One is the consulting engineers want to be the owner's engineer, or they want to be the EPCM contractor. The contractor wants to either be a subcontractor or the EPC provider. The project needs to go through its defined phases: concept study, pre-feasibility, bankable feasibility, and obviously in the consulting engineering world, these are generally linked to CapEx estimates or level of design and things like that. And that's quite clear, those distinctions. In the financing and the commercial world, there's less clear defined boundaries. Okay. But what we often do is a person brings us a concept, or the promoter, how it often works is a promoter has a good idea, a gentleman with the right surname gets a nice coal concession, and he approaches the consulting engineer and say, this looks good. The consulting engineer comes in and let's assume that some drilling has been done. He looks at the quality of the reserve. He looks at potentially how we can beneficiate the reserve. Do we sell it as is? Do we think? And we do he does a concept study. At that stage, we would probably want to get involved, because we would take the financial, or call it the CapEx and OpEx inputs out of his operational model and put them into a sort of a very one-page or high-level thing and say, does this thing make sense? What type of returns are we giving it as that? And at that stage, all that decision, all that really helps you is, yes, it's worth spending more money on the project. Yes, we're in the ballpark within these parameters. Then we'd obviously go into a pre-feasibility type stage. Both the consulting engineers know what that means. Generally involves looking at different analyses or different options, technical options as well as logistical or infrastructure options. We would be involved in that process, assisting them with that. And then we'd also start overlaying some of the commercial issues. If your project relies on Eskom to build a transmission line that's going to take 10 years to build, then for us that might be a very good technical option, but it delays your project by 10 years, because in the real world it's going to take 15 years, because what people say and what people do are very different things. So we start overlaying those sort of commercial issues, and also around the type of contracts that people require. Because the infrastructure might be there, but the type of contract that they are willing to enter into is probably insufficient to raise finance. So we help the client during the pre-feasibility stage. What we're saying to a lot of technical consultants is, because often they are selling these services either at cost or at slightly above cost, because they want to get in early, is we actually don't need a huge amount of technical design done at this stage. We obviously need to be in the ballpark with the CapEx numbers, but we don't have to go to detailed design level. And in many cases, these guys don't want to go to that level because they are doing this for not great returns. Let's rather sort out the commercial issues at this stage. So if it requires an agreement with Transnet Freight Rail for your coal, let's forget about designing the rail siding. Let's come up with a high-level number of what it will cost, and let's rather go and interact with Transnet Freight Rail, and let's rather focus on getting that as our key point, albeit a quote into Richards Bay or whatever the commercial, and let's focus on that. And as soon as we have that commercial document, the project is substantially more valuable, because now we've achieved something. The technical guys then know exactly what the capacity for Transnet would be, or what the requirements are, be it 1 day or 5 days a week, And then in the bankable feasibility stage, they can go to the more detailed design stage, which makes their technical input much better value for money for the client. It lets them take less of the uncertainty out of it, because at the moment they're designing based on a what-if scenario, whereas now we kind of have it there. So in many cases, we're saying to people, let's rather push some of the technical work towards the end, the detailed design. You can't push all of it, because without it being technically viable, I can run numbers through a model, it doesn't mean anything. So you need to do a certain amount of work that gives you some comfort in the technical solution, but a lot of the stuff later should be pushed there. And then that also allows the consulting engineers to focus on the projects that have a better chance of success. Because if you take coal as an example, if 3 people are looking for a Transnet freight rail contract, and they all want you to go to detailed design, the only one you want to look after is the one that gets the contract. So rather wait for the one that gets the contract and then focus all your energy on that one, because that is the one that has got a high chance of success. The big success stories at the moment is the renewable energy sector. I mean, I think government has created quite what can be termed an onerous bidding program, but it's very transparent for government point of view, and no one has yet to take anyone to court to say that you got preferred bidder and I didn't. Which in the PPP game, the hospitals and the prisons, it's all infighting and things get delayed. So South Africa has successfully financed 46 energy projects across wind, PV and hydro. And this is by a number of deals the biggest PPP in the world. It is a PPP because government is an off-taker. So I think from a success story that is there, if you compare that to when they said that they would start and where they ended up, there were delays. In some cases it helped promoters, in some cases it cost promoters, but we've got there now. And obviously we have the rolling projects going forward, and we're hoping that Cogen will be the next program. So I'd say that's a huge success story. People might complain about what it costs to bid. The good thing is that it costs everyone the same, so that there's not one guy sneaking in the front who is not costing him anything. So I think there's quite a fair process from that point of view. Cross-border, we're having quite a bit of success with the coal-fired power station in Zambia at the moment, going through there. There's a lot of energy projects happening cross-border, and that's often where we see, specifically on the coal side, and that's where we see a lot of coal miners that wanted to be coal miners. Unfortunately, the quality of coal is maybe not what they thought it was, or the infrastructure constraints are such, like what's coming out of TET, what's in Botswana going to Walvis Bay. There's huge infrastructure issues. These promoters themselves cannot physically raise money for rail or harbours and stuff. Government needs to do it, and government either is unwilling or unable due to its position. So we're seeing a lot of coal-fired power stations with a mine and a coal-fired power station come on there. We're involved in a couple of those where we're having some success stories. There are, for every good story, there's a bad story. One of the biggest issues there is the fact that you need to sell to a utility. So in this case, it's either the Zambian utility or the Mozambican utility, and unfortunately, most utilities in Africa are not very creditworthy. So there is a huge first mover advantage, because the utility is creditworthy for the first deal, but probably not for the second and third deal. So we've had a few issues there. Changing government legislation. In Zambia, they recently changed the legislation to say that all local contracts needed to be in local currency, which same rules as South Africa, except we obviously have a substantially more liquid market. It's a good rule for the country, but then you also need to box within the weight category that you can fit, and therefore Zambia trying to raise 15-year Zambian kwacha for a coal-fired power station just doesn't exist, or the price just needs to be so exorbitant it's not possible for anyone. So there's been a few issues like that we need to overcome, but we're slowly getting through those. We see a lot of the African deals being export credit supported deals on the mining and the energy space and things like that, and those are generally the more successful deals in the project finance space. Locally, there's certain industries that are still going very strongly. As I said, renewables is definitely the flavour of the month. Mining, obviously, certain parts of mining are doing okay. Gold obviously is hurting at the moment. I mean, there's this whole, never mind the 60% expectations on salaries. You know, if you just look at the cash cost of production versus the pricing, it just doesn't make sense. The big new opportunity that we've seen is agro beneficiation. So we've seen a lot of sugar projects, other food related projects coming along. You know, traditionally that was a no-go space, but now with the margins and the food prices going up, we're seeing a lot of projects coming out there with very good returns. You know, you've got the two of the three safest countries in Africa, Namibia and Botswana, and things like that, and those are much easier. You know, Zambia went up, they had some of their flagship project, you know, the Lumwana copper smelter. The new president obviously has been making certain decisions that has created a few interesting dynamics. Mozambique has been on the up, but without significant infrastructure, it's kind of only going as far as you can. I think you need to realize the language is an issue. You need to have local people on your side. Finding the right person is nearly impossible first time around, so you are going to have to date a while before you find the right bride for your business. If you go into East Africa, there's similar issues, Tanzania, Uganda, I mean, there's a lot of areas that are opening up. Certain countries are still really no-go for small players, for major projects. Maybe Cameroon, DRC, you've got to be a big boy. You've got to be able to influence government policy rather than just stand in line and take it. So you see a lot of the projects in the DRC that have been successful have been large companies, Anglo Gold Ashanti and those guys coming in. I mean, and you need to be able to sit these projects out. If the guys close you down for 6 months because of some issue, you need to be able to cover that project over that 6 months. You can't be going insolvent and things like that. So project finance without parent support is very difficult in some of these countries. You can buy political risk insurance and stuff, but it's not a one-size-fits-all. And then into West Africa, we see a lot of opportunity going. We do quite a bit of work in Nigeria. There's some good things there. Depends which sector you're in. So in energy, there's quite a few opportunities. Mining is still starting out. Once again, it's the right partner. It's political affiliations. You need to structure your projects correctly though. So we'd suggest that they don't have to go through us, but partnering with someone like us, an environmental firm, potentially some legal, is good to provide an all-round solution. It depends on if we're talking rand or dollars in South Africa, outside South Africa. We need to split ourselves between equity and debt. So if we talk equity, and also it's very much dependent on the industry, but on the equity side, if it's early stage development, it's punt money. So it's your rich uncle, AIM listed companies, Altex listed companies, guys like that are willing to take a punt, but obviously want to take a return at the same level. You know, and they want 300% upside in 3 years and things like that. And they have very much a boom or bust approach. You know, it's the traditional venture capital. I invest in 10. 1 shoots the lights out, 2 bakes in cash flows, and 7 die. But one that shoots the lights out pays for the other 7. So that's sort of where you are in that process. And that's relevant for infrastructure projects, energy projects, and mining. Obviously mining is a bit more of a direct punt because you've got to drill in the ground. Okay, but obviously you're only doing it off the back of decent technical information. Then the next stage of developing the feasibility is more, it's still punt money because there's no certainty, but there we see a lot of the development finance institutions providing money. We have a lot of government departments offering grants, like the CPIFP scheme, the Capital Projects Infrastructure Fund from DTI. There's equivalent programs from foreign, Germany and Canada that come in. And then also we find that those early stage exploration companies can now raise additional money from a slightly different investor base off the back of what they've proved to date. And that's generally what comes in. And then at that stage also you probably get some of the trading houses who are willing to put some money in where their mouth is and say, you know, I'll put some money in the feasibility in return for you giving me a 20-year offtake for 20% of your capacity. So that gets to the equity side. Then we assume we complete the bankable feasibility. We tick all the boxes. The banks are happy, the equity guys are happy. We trawl through the legal documents, we sign it, we all stand in a room, and it's lawyers make lots of money around it, and then the money's available. We achieve what we call unconditional availability of funds, so the cash is now ready. That money is really coming from, on the debt side, it's coming from the traditional commercial banks. Okay, South African banks obviously are very good at doing rands. Outside of South Africa, South African banks are very expensive in dollars. They need some assistance, and with that, they use export credit agencies and other potential government support to make themselves more competitive. We see a lot of the international bank, well, some of the international banks still playing in that market. I guess Barclays, Absa are linked, but some of the French banks, some of the German banks still willing to play. They prefer Africa, but South Africa, but if they go into Africa, they also need their export credit agency to provide support. And then on the equity side, we see once again either a listing approach, once again targeting a different type of equity investor who now has less risk, is willing to pay a premium because the risk money has been taken, or the risk has been taken. DFIs are willing to put some money in. We see IDC and IFC taking very active roles. And then also even institutional people coming in. So some of the pension funds have managed to unlock some of their money. They might not come in at financial close. They might come in at year 1 or 2 of operations once this project has started kicking off some cash flows. And you see some of the guys flipping out their shares and other guys coming in at that stage. And that's sort of the traditional value chain in finance. What we see now is that obviously engineers link up earlier than later with gentlemen like ourselves who can look at the project in a holistic way and therefore prioritize which in the little funnel which one to focus on. So I think that is important for people to do, and you get an opportunity, and we have a good example of that is guys to us, a lot of guys come to us with great projects in Zim at an ungeared IRR basis. So before we talk about gearing, this thing makes money. But you cannot raise debt into Zim. So all due respect, you should rather focus on something else. So focusing your time on the right things is important. Certain countries cannot raise finance due to things they've done in the past in terms of reneging on World Bank deals and stuff like that. So you need to focus on the countries you do. So cross-border is definitely where to go, but you need to have some experience of where to go. I wouldn't just throw a dart at a dartboard. I would have a sector focus. In terms of going out there, it's obviously focusing on it, leveraging off some of the DTI schemes coming in, and then possibly tying up with other local consulting engineers there to have most tenders or requirements in those countries require some sort of local content, like our equivalent of BEE, and therefore you need to partner with a local company. So their suggestion is that a lot of guys who are going out there should get their local companies that they feel comfortable with to work with, find credibility in. Unfortunately, you only do that by working together and going through some pain. So pick 1 or 2 guys and go out and make friends with them and make sure you're working together. But that's very much our approach. I think the rules of finance linked to technical projects are the same. No matter, within reason, the industry and things like that. So the technical services the gentlemen are providing is the same across that, and therefore they need to consider all these things. A lot of the companies say they are a one-stop shop. And Deloitte and Venman have tried to do this one-stop shop. And we question if that will go where it needs to go over time. Guys are trying to do that, but in our experience, you pull the best out of each team to get the A team that gets you over the line, irrespective of what size company you're doing it with. So in many projects we come across, be it mining or energy, and often mining and energy, as I said, are interrelated, albeit there doesn't have to be a coal-fired power station. You need to have diesel gennies or something to run your thing. Is often they're sitting, unfortunately not many of them are sitting at the end of a stable Eskom connection, if Eskom is considered to be a stable connection nowadays, with a 75% interruptible. So often they are very linked to infrastructure. And infrastructure would be rail, roads, transmission lines, water treatment plants, sewage, if you're in that, and we've been involved in a number of infrastructure projects like that, and let's leave roads out because that's a separate discussion on tolls and things like that. But other base infrastructure is very difficult to project finance using commercial money. and things like that. Specifically water projects and things like that, which often people need because the cost of finance is very expensive. You're not getting deals at LIBOR plus 1%. The base price of which people are used to paying for infrastructure is very low. And there's generally a huge political or social upheaval against water projects where suddenly and things like that. And therefore the financial constraints don't work, and the project just doesn't get off the ground. I mean, we looked at a water reticulation project in near the Barberton area. This was about 5 years ago, and historically they've been paying 6 or 7 rand a kilolitre of old depreciated assets. Great, things are dying. For us to make the dam and the associated reticulation work, and this is for the equity provider in this to get a very low return, 15% maximum geared. This was not a money-making opportunity. We needed to triple the price of water to sort of 25 rand, which internationally, or per kilolitre, which internationally probably isn't a bad price, but for that is just unheard of. And therefore the offtake wasn't there. And where we are is they still haven't built anything. They're rather throwing O&M at the old one, which is a short to medium term solution, not a longer one, but it prevents them from growing any more economic, be it on the mining sector or something like that. And unfortunately that doesn't work. And that's where you obviously need government to step in, or the World Bank and things like that. Unfortunately then you're in a long bureaucracy, and so therefore there are, and that's why we say only 1 in 10 projects gets to financial close. And it's not because the project is bad or because the promoter doesn't know what he's doing. It's that he is so dependent on other infrastructure related issues or permits or something that are outside of his control that his project just can't go ahead. And by the time this comes on stream, the market has changed. I mean, your niche opportunity for this sort of commodity was great then, but it didn't work. And the only way that these projects can afford to fund infrastructure is if they're very profitable. And the IRRs are so high that they can allocate some of that cost to things like that. And there's very few of those. And to be honest, most of the low-hanging fruit in those things have been picked already in the 60s, 70s, 80s and 90s. The only low-hanging fruit, I'm talking mining specifically, that still exist are in the really interesting jurisdictions like South Sudan and Eritrea and stuff. And those are where the IRRs are there, and not that many people are willing to go there. So there's a bit of a catch-22.